Welcome to the webinar today. We're going to be talking a little bit about Virtual CFO Services, what we offer, and how you can how our offerings can really kind of help your clients and help your clients succeed on a financial statement spectrum. The presenters today, obviously will be myself, Jody Grundon. I started Summit back in 2002, and then with co-founder with Adam Hale. Also be with us is Christy Buchanan. Christy leads our strategic growth at Anders, and then Tom Waddleton. Tom, one of our first CFOs, and he's actually one of our pod leaders overseeing our CFO team. So all three of us will be talking today, kind of interacting, going back and forth. Use the chat as much as you can. That will kind of help spur things on. So as we go through things, if you have questions or want us to repeat something or get more detail about it, feel free to just go ahead and put it in the chat, and we'll be managing that pretty thoroughly. But to kind of give you kind of some background before we actually get started, wanted to talk a little bit about Summit, again, to give you that basic background there. Started back in 2002 as a more traditional accounting firm. We did tax, we did write-up work, we did all the kind of stuff that normal accounting firms do. Then in 2004, we started kind of changing the way that we did things in a lot of different manners. We quit the hourly billing with the flat fee. We started focusing on what we called Virtual CFO Services, and at that time, Virtual CFO Services really didn't exist as a service. And so it was something that we were really trying to kind of get our hands around. How can we provide something a little more in depth for a client outside of just simply a financial statement? Because working in public accounting numerous years before that, and then also working on the corporate side, it was one of those deals that when the financial statements were done, they were put in a box and really never looked at again, and not really used the way that they should be used. And so with the Virtual CFO Service platform, we really wanted to start really providing something just more than that. And that's what we initially started in 2004, and then gradually introduced the service over years. It didn't take off very quickly at all. We picked up maybe 2 or 3 clients in the first 2 or 3 years on average per year. And it wasn't until about 2013 that we started really seeing significant uptick. And that's when the web is really starting to come around. In 2011, we actually started focusing on verticals that we work on. We'll talk a little bit about that in a little bit here. And then in 2013, we transitioned to a fully distributed firm. And what that means in today's world is we were fully remote. And so we got rid of our office. Everybody worked from home. I think at that point we had about 20 folks on the team. And then over time, we only hired outside of the state of Indiana, which we were actually formed back in 2002. And since then, we had over 60 folks all throughout the United States. And we also have a few folks in India and then also in the Philippines. So we've really kind of branched off. Our next venture is we're looking to hire a few teammates in Mexico. So we're kind of even branching out into the South a little bit more. In April of 2002, we had the opportunity to join Anders CPAs and Advisors out of St. Louis, and we merged with them in April, which again, they are a top 100 accounting firm. And we had at that time about 60 people on our team. And if you add another probably 15 contractors, about 70-ish folks. And then Anders was bringing about 300 people to the team. So now our team is just right under 400 people. Our division, the Virtual CFO division, consists of about 100 people. So we've got about a quarter to a third of the team is actually in our division right now, and will continue being there as we grow. So again, you might see the different logos as you see the different teammates coming at the different events. And basically, Summit became a division of Anders. So we took the Anders brand and the Summit brand, combined the two of them, and we are a part of it in a working division. So the company really didn't, in a normal merger, companies kind of disperse into it. Our company stayed as is and is working as a unit inside of Anders with a really high growth goal. We want to grow upwards of $50 million over the next 5 years. And so right now we're hitting at about the 10 to $11 million mark and growing at about 35%, annually. And so just doubling our size year over year, we should be able to get really close to that. But with the merger, we feel we can really kind of put that on steroids and really boost that up and get there a lot quicker. And so that's our 5-year growth goal is about a $50 million dollar pace. And that's where Pinnacle can really kind of help us as a firm grow within Pinnacle itself. The three things that we've always focused on, and I've talked many different conferences throughout over the last 10 years, mostly accounting and then industry related conferences. We always talk about people, processes, and tools. When people ask, because you see now that when we started the virtual CFO process back in 2004, again, it was more of a foreign language. People really didn't know what it was, how to do it, and all that kind of stuff. And now, if you look on really any kind of accounting website, they always say back office accounting, virtual CFO service. There's some sort of terminology they're using referring to it. I would say the big difference between those firms and what we would do is that those firms can do what we do. This is really what we do. And so that's a big term and a big flip, because this is what we focus on strictly would be the virtual CFO service side. And so our team is trained in that aspect where we have CFOs, we have accountants, we have senior level accountants. We've got we basically have a full supporting staff of folks that are managing accounts. So when we bring on a new client, the client's going to have a team associated with it. It's just not going to be a lone person that's on that account. And so depending upon the mix, and Chris, you'll go over this here in a little bit, but depending upon what the client picks as their adventure with us, the different team members will be put on there accordingly. Processes that we talk about are so important. We've always been a firm believer of E-Myth. We've been a firm believer of a lot of different philosophies out there, but the biggest thing is we want to have a repeatable process. We want all of our clients to come in and feel the exact same process, the exact same feeling, exact same experience. No matter who their CFO is, or who their accountant is, or who their tax person is, or whomever that they have on the team. And so we've really kind of developed and fine-tune those processes all the way from onboarding the client, which is usually about an 8-week process, through the onboarding process, all the way through until the year after year process, or maybe even offboarding a client, whether we offboard to another team member, offboard to another firm, or offboard to an individual. We go through that same process to make sure everything is very smooth. And then the tools that we use are always the tools that make the most sense. And so we don't get stuck with tools, meaning that we don't get attached to them so much that we get foggy and realize that there may be something better out there, a better experience that for our clients or our team. And so we're always looking at new tools to use throughout the process. So as we go through today, we might talk about something that we're really high on. Maybe it's a forecasting tool. That forecasting tool may be great today, but maybe a few months from now we might find something a little bit different that makes more sense and it's a little bit better. And so we're very quick to adapt to the different tools and so forth. But with all three of them, we're really focusing on the three together is really makes the whole experience for our clients extremely strong. And that's why we get such high NPS scores and high client ratings, 5-star ratings. I think our 5-star ratings right at about a 4.5, and our NPS is around 85. So it's super high NPS score, super high 5-star, and our client retention is right up there about 94%. So everything is really based upon how we present the people, the process, and tools, and all three of them that we really focus on and fine tune. Mm-hmm. And then, when we talk about the CFO service, kind of what does it mean? A lot of times when a firm will talk about it, they're talking more on the accounting process, and that's really not what we're providing. We can provide the accounting process. That's about a third of what we do, maybe about 40%-ish, somewhere in there. But the CFO side is really what we're looking at, because we're the chief architect, the coach, the advisor. We're that person providing the strategy and sitting alongside the business owner on a weekly basis for the most part. A lot of our engagements are where they're meeting with them weekly. Some are every other week, and some are monthly. But for the majority of our clients, we're sitting alongside them, really kind of helping them steer the ship on a financial metric, and so basically financial modeling. And so the experience is really evergreen. It's not come in, fix a problem, and then leave in 6 months. We actually become the solution. And so that's why we see that our clients on average will keep us on their team for over 4 years. It's like 4.5 years right now. And that's growing as we add new clients. And so the experience is again an evergreen, not to come in, fix an issue, and leave.
Mm-hmm. Sorry, I'm slow on the switch there.
Yeah, no worries. And then the term that we coined was profit focused accounting. And if you can click to the next slide there.
Yep.
Profit focused accounting. The biggest part of this is that when we actually do modeling, we're always looking forward. So a typical engagement will look a little bit on the financial statements in the past, and then from there we look going forward, and we're looking more towards the future, whether it's a short-term future or whether it's a long-term future. And so, but it's all based on what we call profit focused accounting. That's where we look at the goals that the client has, then we break those goals down based on the non-financial revenue drivers. And that's the important kicker there, is because we don't just simply say, hey, we're going to grow 10%, and then magically 10% is going to happen the next month or the next year or whatever. We really break it down and break those non-financial drivers down so that the client can actually control the outcome. Because it's hard for a client to understand how their business is going to grow if they don't have control over that. And so, as Tom will show you some of the metrics later on, we'll talk a little bit about those drivers themselves. The drivers, and what do I mean by a driver? It could be, if you're a truck repair shop, it could be the number of trucks that's coming through the truck repair shop. How do I, am I forecasting to have 8 trucks to come through, 10 trucks to come through, 15 over the next week, the next day, next month, whatever that might be. And then the average, price on the repair of those trucks. So it can kind of be a combination of a few different metrics that the outcome can be controlled, because again, that's what the owner has the most control over. And so using those metrics is super important to have those metrics first and foremost in the client's mind all the time, and then how those really impact the forecast. And so with a forecast, revenue and balance sheet forecast. So again, we're looking at what the cash position is going to look like in 12 months and 15 months and 3 months, so that we can do some planning today to impact that forecast. And then what we do is we also integrate any type of a pipeline they might have already existing into it. And so if the client has an existing pipeline built into their forecast already, we'll shore it up a little bit over the next couple months to make sure that we're not forecasting too high, because we're always going to forecast to capacity, and then we're going to realize that we're shored up based on the pipeline itself. And Tom, kind of walking through this, and you're kind of more in the weeds than I am, with the clients there. We're always providing the strategy here, and the key part of it is having named convention name meetings for the most part. And so, Tom, if you could walk through each one of these and kind of explain a little bit about what they are, that might bring a little bit more light on the different types of meetings that we might have with the client.
Sure. And a little bit later, we'll talk about the cadence of meetings and kind of say where they fit. But if you talk at start at the very top, cash flow. So cash really is the oxygen of the business. So we have 2 different ways that we do this. This one primarily looks at a short-term forecast of cash, where you're specifically looking at what cash do you expect coming in, what needs to be going out. That can be a very near-term discussion with an owner, like, hey, in the next week, these bills need to get paid and payroll is being run. Here's who's past due on receivables. And then looking forward, are there times where an owner's going to need to put money in the bank, or do they have the cash to pull it back out? We also have the long-term forecast, as Jody had mentioned, that kind of leads into the forecast. That part of the forecasting is going out several months. What does that forecast look like on a monthly basis that you're going out full 2 years? Forecast is a really important part of the strategy. So that looking forward, understanding where the client wants to go from a goal perspective, and then putting in with the realities of the business and decisions they want to make, including modeling. Very commonly, is it time to hire someone? Is it time to do this? And so we'll forecast that first and show the impact to really help them guide those decisions. Pipeline is a real focus on sales. So what is coming of the work that's being done? What do you have in your sales funnel? Having some different metrics about what is your win rate? What's your average size? When are things going to happen to look forward? That's a key part of the forecast, but a really intentional look at the sales and what you have upcoming, and then decisions around if things look light, where are we going to focus, or where do we really have to pursue to get deals struck and then go ahead and receive the revenue or see the revenue. And then the financial statements. So what actually did happen, making sure those are accurate, can explain how the business is working and what things are happening within the business. So strategy is really the most important part, and all those things connect to it, but you've got this whole circular piece of how we kind of connect those things together. Okay, so if you go on now, we can talk financial performance, and it's probably telling that, you know, we're probably a third of the way through this before Jody even mentioned accounting. And now we're talking financial performance. So things like strategy, people, process, core values, all those things are really important to what we do. If you're in accounting, and even if you're not, often what you will hear is owners don't really want you to report what happened backwards. They want to help go forward. It's easy for them to look at. So that really is the approach that we take. So we use those financial statements to say, how do we look forward, and really work with them as a consultant in doing this. So I'll tell you the kind of key things that we have, and then I'll show you some examples of what we do. So money in the bank is a really important one, right? If cash is the oxygen in the business, just where are you? Where do we see it going? We have different measures set up around, do you have money set aside for taxes? Do you have the right amount of cash reserve set up? We'll help them plan those and then track against that. Production metrics, Jody mentioned the non-financial metrics. These are a big part of it. So how is your business really doing? If I can look at this from a non-financial standpoint, which very often helps tell the story around the financial part about. And then the financial metrics. And then I mentioned pipeline. What measures do we have in place to help you understand your pipeline of sales activity? So if I show you just a couple of examples in different industries, and the top is a very common kind of company that we work with that we call digital agencies. So digital agencies work like a lot of firms. They're a service-based business, and mostly they generate revenue by hours times the average bill rate. So what you'll see in this metric, and you're seeing months go across, and the dark blue bars are the actual utilization for the month. So what percent of the hours were billable divided by your production team, what percent you actually paid them for, right? So if they bill 30 hours a week and you're paying them for 40 hours, then you got 75% utilization. What you can see on this chart is how did you do compared to the average? How did you do compared to your goal? And then what's a long-term trend? Those are the lines. And then one of the more important one is the industry average, which is that red line. And I'm sure as consultants, you'll find that when you have good benchmark information, it's very impactful to the clients. So a common conversation with us is we think that you can get your billable hours up. And what we'll hear is there's no way to do that. We're really pushing people as hard as we can. And if you were this kind of client, your conversation would be different to say, you know, look where you are compared to the industry average. This one looks like if they're so high above it, you could be talking about are people being burned out, as an example. Often we'll see people are well below that. Okay, if I move on, then if I look down in the bottom left, I'm seeing service revenue. And service revenue is being broken up by different categories of service. So this particular client, you're seeing 3 different time measures, and they're seeing the revenue go down. In this particular one, what they're seeing is that lessons have dropped. So not only do you know it's going down, but you're seeing the main reason that it's going down to dig into and say, is that good or bad? They are seeing memberships going up, but you're breaking down their business to not just say, hey, revenue dropped, what do you think we should do? And kind of stare at each other. Where is it dropping? That allows you to dig in and say, what's happening that's causing that to happen? And then Jody mentioned a truck repair example. You got 2 different charts, and the one on the right would be a little bit more typical financial chart that you would see of dollars. And you see dollars going up a little bit. You can see it compared to a forecast, and they're doing better than the forecast. On the left is more the non-financial metrics. And so you're seeing a line that says what was the average repair value. And then the bar chart shows the number of repairs going in. So something happened in the month of May where the number of repairs went down significantly, but the average price per repair went up. And if you look at the month, it would look fairly normal from a financial standpoint. So that would be a really good one to dig into to say, you know, was this a case where there was such a big repair coming in that you were turning customers away? you could only handle certain business, but you didn't see it from a revenue standpoint. Maybe as
Yeah,
an owner, you're okay with that. But Jody, you've got some context on this, I think.
yeah, I think another important part about the metrics is that if you can kind of see, we're always looking not only in the past, so the metrics that happened in the past, but in the first example at the top there, we're looking at those are actuals through May, and so we're adding a couple months onto it. And actually, if you were to look at other metrics within this organization, you'd probably see July through December. So you'd see all the metrics that what the expectations are through the remainder of the year. And again, the same thing with the truck repair company. The discussions, pretty fun each month. We're talking to this individual, and they explained, yeah, we just barely hit the number last month, and so we kept it at 8, and then we come back in June, and now so it looks like you had 13 trucks come through. And so now the discussion is that going to be a normal thing going forward? Because if it's a normal thing going forward, then we need to adjust all of our metrics going forward. And in this case, they said no. They said they think it's a one-time thing, but they wanted to keep it at an 8 client, eight trucks coming through. And so we kept it at 8. Now, next month, if it comes through and it's 10 or 12, we'll have that discussion again. And more than likely, because we've had that discussion already once or twice, we'll end up bumping up the number of truck repairs coming through. And my guess is that would happen. Maybe it's 10 in July and August, and it drops down to September will drop down to 8, and so forth and so on. So those are the types of discussions that we have. But then once we look at that, then we'll flip it over to the balance sheet side of it and really kind of show them what the impact on cash is going to be. So cash throughout the year is so that's going to increase your cash, your AR. In this case, they have inventory. It's going to, your inventory is going to be at this level, but it's also going to be, hey, here's what types of distributions that we're anticipating that you'll be allowed to take, for taxes or profit distributions or whatever. So those are the kinds of discussions that we can have so that the client can not only work in their business here and really kind of, figure out how to make the most out of it, but how that's going to really impact them personally. They'll be able to see that as well. And so the discussions are super important throughout that time. And again, with this client, we meet with them twice a month for this example.
Yeah, and we led off with the non-financial metrics. And Jody, your experience may be similar to mine. I'd probably spend as much time talking about the non-financial metrics in a financial statement review as I do the financial metrics. That's the owner's language.
Yeah, kind of weird because a lot of times when you think about an account, they typically go line by line through the financials, showing, hey, here are the variances between the different stuff. And after you've done that a few times, the client's eyes kind of gloss over a little bit. And so the big thing about this is I guess when we do we line it up for a client, we're talking about the historical stuff for maybe 15 minutes of an hour discussion. I would maybe 10 to 15 minutes. And then from there, it's important of the CFO to identify the key metrics that they want to talk about. So when they come into the financial statement, they may point out and say, what, hey, this looks a little odd. And so I'm going to dig in a little deeper. Here are the metrics that I'm going to talk about with the client or bring up to the client as a, potential issues. And we say potential issues because, on a financial lens, we don't know if they're potential issues. We know we can, it's kind of like the, we've got the idea and we can see how it's impacting stuff, but really they know what the issues are. And so when we bring it to a client, like in this case, we may say, hey, back in January, why did, we were forecasting, maybe we were forecasting 10 and we only came in and had 7 trucks. And we looked at it and said, wow, what's happening here? And they may say, well, because of X, Y, Z, happened. And so then the discussion becomes, more on the production side or the operations side, or we can, it may take the discussion somewhere completely different. Why did your utilization get missed? And then they might go into this long thing about holidays or, something that they didn't, foresee. And in that case, it's like, is it a one-time exception again, or is it something that's going to reoccur? And that's what the CFO has to determine, based on the discussion, so that they can manage that forecast. Because again, the forecast is going to be key to the health of the business, because they're always looking at least 12 months out. And a lot of times it's more like 3 years, 3 to 5 years. But for the most part, every client wants to see where their next 12 months are, and they want to see where they're going to end at the end of the the calendar year too, so they know what their tax situation is going to be, so you can kind of compare one year to the next, that sort of thing. But I guess the importance here is, again, we focus on those forecasts. And maybe, Tom, you could maybe you're a little different on that. That's when I was consulting, 15 minutes tops. That's all the interest I could keep with a client on old stuff. And then it was like, okay, so how are we gonna impact going forward? And then the modeling starts.
Yeah, I agree completely. And we would get to, and I'll go ahead and talk about some of the financial metrics. So that is part of it. Very similar to you, Jody, we don't go through the income statement and balance sheet at a really high level compared to forecast. But a couple key metrics that we think really help our clients. If you look at liquidity position, so liquidity in the short term, essentially, what can you turn into cash quickly, like your cash and receivables, and what do you owe in the very near term? So that's your total liquidity. So you're looking here at the very bottom of this chart, or this second blue bar, of what the liquidity of this company is. So $2 million in May, and then this arrow indicates that it has gotten higher or better since the last month. So in the month of March, it went down, and then it came back up in April and May. In each individual metric looks like that. So you can see cash is higher as we come down, but accounts payable is also higher for the month. So that's a negative if you look at from a business standpoint. This can be a really good chart here. And then at the top, you'll see a 10% reserve goal. Our recommendation is 10 to 30% of a trailing 12 months revenue of a company. That's what you would have in cash. So in this particular one, their operating reserve goal is $612,000. So they were a $6.1 million company. If you look back one full year, saying you should have $612,000 in the bank, they are currently $428,000 above that if you add their working cash and their cash reserve together. So just a really good, healthy metric. And I mentioned that we want people to have tax reserves. This client doesn't have one. We recommend they do, but that is not part of what we consider their reserve cash. That's already been set aside to pay the government.
Yeah, and I think the big thing about this is that there's a lot of discussion over this typically during the call, because the client, one, is always asking, hey, how's everyone else doing? Is everyone else's cash position? And the nice thing about it is we can, broadly, really show them, where in other metrics, where we compare with everyone else. Another thing is that they're always, hey, what's coming up? So the discussion always goes, hey, is a 10% reserve goal, is that enough? And again, it's 10% of annualized revenue, which is what Tom had mentioned there. And 10% equate for a service-based company is equal to about 2 months of expenses. 30% is going to be really close to 6 months of expenses. And so the client, based on their risk tolerance, will determine, hey, where do we want? And you can kind of see there's a drop-down menu there on that. We can easily go from 10 to 15 to really whatever percentage the client wants there during the call, so they can see exactly where they're at. And the nice thing about the metrics are that the client has access to these really at any time they want. And so as we close the books, they have access to them, right away, and can get to them at any time to see exactly where they're at in comparison there. One thing Tom did mention is that that there's nothing in tax reserve for this client. And so that's, again, something that we really, really pound hard, is that, you really need to have at least 40% of your forecasted net income set aside at some point throughout the year for taxes. And so the second, or the bottom to the right-hand corner, Tom, that's the taxable income conversion there.
Right.
With the nice thing about it with our clients, they get this every single month to see exactly what their tax position is going to be. And so if you could walk me through this real quick, Tom, that'd be great.
Yeah. And I'm glad you mentioned that, Jody. So in the financial statement, each month we look at this. So even early in the year, this happens to be a cash basis clients. You can have accrual basis or cash basis for taxes. And the two columns of number are, where are you currently year to date, and where do I see you being at the end of the year? So this takes, at the end of the year, I forecast our net income is going to be 1.6 million. And then the usual adjustments that you make to go from that accrual-based management report to a cash-based, like make adjustments for what cash did you actually collect in your AR and what did you pay out in your AP. But this client, I would be saying, hey, as of today, it looks like you would owe $182,000 for year to date, but end of the year, it's a $660,000 payment. And if you continue down that table, I can show for this particular client, this is sample data, but you have not made any estimated payments. and you haven't set up a tax reserve. So this would be a pretty serious conversation of saying, it's going to be a check of $660,000. And Jody, you and I both know the difference between a client who set that money aside when it comes April 15th to make the payment versus one that hasn't. And I had a client this year who doesn't like to set it aside, but all year I was saying, I think it's going to be around $500,000. He wrote a check in April, like 350, and called me all upset. And why do I pay the government this much? And so it was just, we've talked about this all year long to do this. This is what you owe. It's so different if the money is set aside anyway, to say, this is what you set it aside for. The check comes out of there. So, but it's just mainly to avoid surprises.
Yeah, the key part about this is they know where they're at all the time, right? So every month we have that discussion. So every month we're talking about it. Hey, based on what happened last month, here's what our projection is now: 662,000. Last month maybe it was 500,000 or 700,000 or whatever. But we always tell the client to only pay the minimum amount of taxes due. So that's your quarterly payments from the prior year. So those coupons that the tax accountant will give you, that's the minimum that you want to pay. And then you pay that the first quarter, the second quarter, and then really after that, based upon how you're trending here, we determine, hey, do we need to make lesser payments, or do we need to continue on at that minimum payment? And we'll never tell them to make more. It's always going to be, hey, make your quarterly payments. Because what happened is we're setting money aside every week or every month in the tax reserve account. And at the end of the year, that difference that they're going to owe, in this case, let's say they made, 3 or 4 payments equaling $600,000. Well, the $62,000 would be in that tax reserve account, ready for them to make the payment in April. And that's what Tom was saying. The payment's a lot less, it's a lot less painful mentally for a client if they know what it is and it's set aside and it's already managed for them, than if they had this huge payment at the end of the year. And I've had, Tom's not the only one that's had that. When we first started, we had clients that had $500,000 to $1 million tax due, and all of a sudden, when that payment comes due, it's like the world's coming to an end, and everything is everything's going wrong. Whereas with that same client and getting them set up, and they're just simply signing the check and they're paying an extra $100,000. And they're super excited, so the same amount of tax, that they're paying. It's just a matter of, hey, it was set aside, out of mind, not included in any of their cash reserve balances. So they weren't planning on using it for operations or anything like that. They're using it strictly for what it was intended for, which was paying taxes.
Yeah. And when clients do this well at that financial statement meeting, this chart would say, for example, you're about $70,000 short on your tax reserve goal from where we were last month. You had a great month. Let's go ahead and move $70,000 into that. And that seems much more palatable as you go through, and then you can make your estimated payments out of that. So to continue on with this, we've got an accounts receivable at the top. A big part of the conversation with this client would be, okay, if we have a goal of 45 days, you can see we've met that just once. It looks like it's going up, and compared to that red line with the industry average, people are taking much longer to pay you. So if this was the same client, you'd say, you've got good cash, but how much more cash could you have if we could bring that under control? And this just kind of highlights that, yes, it looks like it came down for a little while, but what's going on that is making that number go back up?
And we always try to cite that industry. You always try to cite that industry number in there, right? Because what does the client always tell us?
Yeah, no one can do this. They just pay slow. There's nothing I can do, right?
Yeah. It happens all the time. Whereas if we can show it to them, then they really, their excuses kind of walk out the door. So they understand that they need to kind of step it up a little bit and figure out how's everyone else doing it? Why are my receivables so high, AR days so high, and everyone else is lower? And then again, that's where discussion comes on. And so that's the strategy part of the engagement.
Yeah. So if we turn our attention a little bit to the short-term cash flow, and I mentioned this a little bit before. So short-term versus long-term. So long-term will be in the forecast, as Jody talked about, looking out that 12 months, sometimes 2 or 3 years out. So if you have an owner working towards some particular event, I want to pull a lot of money out of the business, I want to build up money to buy something, whatever this is, you're looking at that long-term piece. Most of our clients, when we start working with them, don't have that cash reserve set up. So you can say, okay, now we've gotten to the point when we build this forecast that in, say, 1 year, we've got that 10% set aside, and they can see that. The long-term, though, doesn't take into account that, hey, next week, you have to pay a big bill before you've gotten paid by a particular customer. You could have that kind of strain on your business. That's the short-term cash flow. So very beginning engagement, we talk about those cash goals with people, understand their cash. This recurring cash flow meeting with our clients is a once per week meeting. We use this tool called the cash flow tool that connects in and pulls in what are your receivables, what are your bank balances, what payments need to go out. You've got the ability to forecast to show them that. And then it's sitting down with the client and showing those things. And those are action meetings where the clients will often say, okay, go ahead and pay these bills if we're doing that for them. Sometimes it's hard decisions. If they're cash tight, you can say, I'm going to hold off and not pay all the bills that are due. But you can say these are transfers, things coming in. So it's a very action-oriented meeting, and then also looking out several weeks to really understand where that client needs to be. So that's our focus from a cash flow standpoint.
Yeah, and kind of relating this to a client story. We had a client, this is probably back in 2000, I'm guessing 2007, 2008. And so it was relatively new in our venture with the CFO service side. And, with that, the client came in with significant cash flow issues. Cash flow issues so significant that they were negative cash all the time. We're talking negative 30, and Tom, you know exactly the client I'm talking about.
Yeah.
Negative $30,000 plus every single day. And so the client would, we would have a cash flow meeting, kind of going through over the next week, because we had to break it down weekly for this client because they were so tight on cash. And they would be like, okay, I'm getting this money and getting this money on these dates, and I'm going to write these 10 checks. And they're like, well, we can't because it'd be negative. And so he would hold the checks until his bank balance showed positive, and then he would real quick cash the check. And so it was one of those, or send the check out. And so it was one of those deals. He was really playing the check game, and he continued on. He'd been doing this for years. And believe me, I don't know how his blood pressure, how he didn't have a heart attack or something. That'd be stressful. But it was a constant, constantly playing this game every single time. And then the bank would call, and you'd field the bank calls. Hey, we need to get it, back to zero, a zero balance plus. And so we would do that and then play the game again. But in reality, that's not a game we can play forever, right? And so that's just that's a short-term cash flow need, and short-term cash flow issues. The key there is once we had them balanced out and showing, we'll kind of show you what a cash flow looks like here. But then we flipped it over and we really started focusing on the long-term issue. And the long-term issue is when we started discovering, the lead and lag indicators, right? Why is cash always short? Well, cash is short because of XYZ. In this case, it was the way that he was pricing products, and he was the buyer and the seller. He was playing both ends for the company. He was buying the material and selling to the client, and he was kind of betting against each other. And so we had to kind of put up some barriers there, and Tom can kind of probably tell a little bit more about that now. But then also he had another company that was highly successful, one that was doing really well. At the time we took him over, it wasn't doing really well. It was also in bad cash position. But through the long-term modeling, we were able to look at it, and it was just simply a product mix. He was chasing revenue, and we found out that the highest revenue products didn't end up being the highest profit margin products, and the one that kind of gave him the most headaches. And so we changed the product mix, or the focus on the product mix. And once he started selling more of the smaller products with higher margins, well, he just really hit it out of the park. And unfortunately, hit it out of the park so well that the profitable company was basically subsidizing the non-profitable company. And so it was like, and Tom, if you could kind of go a little bit more further into that on, the different types of discussions that you might have had with him to really kind of balance his company, because it becomes a success story.
Yes. Yeah, it really did. So if I talk the short-term piece, the one thing that really did help is once he started to trust this process, then he stopped with the holding the checks on his desk, because he would listen to us and then kind of ignore it. And like you said, Jody, let all these checks sit. So the common thing we would say is in the cash flow, like, hey, it looks like you have negative 50,000 worth of cash. And he would say, there's no way, there's 20,000 in the bank. And this happened in multiple meetings where the senior accountant then said, hey, can you tell me which checks are sitting on your desk? And he would go through and say, well, I got this one for 10,000. And she's like, that's the difference. The bank hasn't seen those yet. Shining a light on how much money he was pulling out of the one business to put into the other was very significant. He did not notice how much it was until we started. We would do the financial statements both times and say, here's how much you're funding this business for. These losses are costing you a huge amount of money. You've got one successful business. and you're not seeing really the benefits of it because you're pulling out all the money and putting it into your other business. So he agreed to stop doing that, and he's really righted both businesses for he's just killing it right now. But I think a lot of it was just him saying, okay, I can't keep funding this business. Why would I work this hard on a business just so that I can keep putting in money to keep the doors open? And I think that realization of us just continuing to sort of pound that drum really helped him on that. I didn't show in the short term, just to give you a quick visual, and this is very summarized. But when we walk into a cash flow meeting, you can see that this week and then weeks 1 and 2, and imagine that going out to 13 weeks. And here in the top section is cash coming into the business. And so there was a transfer that went out, money that came in, and we would say where it came from, and another transfer coming in. And then you got the different things that are going out. And so there was a payment that went out to this person. And off here to the right is where we would put forecasted spend. And so they can see, okay, at the end of the week, I should have 85,000 this first week. Next week, it'll be 64. And the next week, I've actually got a loss of $11,000. That could prompt a conversation of, let's take another look at your aged AR. You've got these 5 people that owe you maybe a combined $30,000. What are we doing to collect that? Because without that, you're going to need to be putting cash into the business as the owner to do that. And so that's what we're walking through each week. And this miif be also where they then say, okay, yes, I'll go ahead and approve a payment going out for people or recognize what things are coming up.
Yeah, so no matter if they have, if they pick, our virtual CFO platform, which is a weekly meeting, or our controller platform, which is a every other week meeting, if they have us doing bill payment or actually doing receivables for them, we have this meeting with them monthly, or not monthly, but weekly.
Yeah.
And the important part of this is that we want to make sure that all inflows and outflows are accounted for during that week. And then also when they stop and say, hey, I'd like to release this payment, or they tell us the 10 different things, we're not using the other software's version of approval process. We actually have the approval process right in this meeting. And so I'm hearing Tom say, yeah, go ahead and pay start now. We go ahead and plot it in there, it gets done and taken care of. At no point during the week do we differ from that. And so if Tom were to call him, let's say Tom's the client, he would have called me up and said, hey, or sent me an email and say, hey, let's pay A-Star Staffing or whatever. And A-Star Staffing wasn't even on the agenda. Tom immediately red flag pops up because it never popped up in our meeting. And then instead of actually just go ahead and paying it, he would actually pop on another call and make sure that it was truly a legit a vendor to pay. And with that, we batch all of our stuff so that the client's used to, hey, everything is getting paid on a weekly basis. Receivables go out on a monthly basis or semi-monthly basis or whatever that might be. But the cadence is always built in there. So that when they go into these meetings, that everybody's on the same page, the approval processes are all there, and we eliminate a lot of noise back and forth from our department to their department. Hey, did you pay that bill yet? Is that bill paid? How much cash do I have in the bank? All that stuff's taken care of during that meeting. So again, it puts the client at ease, and then they can focus again on their job and not focus on the financial side of it.
Yeah. So if we switch gears a little bit, let's talk about the forecast, because we've mentioned it several times as being important. So I'll tell you a little bit about how we actually do the forecast. And it really is main there so that you can make actionable insights. If I make these moves, what does it look like in the future? So at the very beginning, this happens at the very beginning of our engagement, which probably does for the Pinnacle people as well. What are the goals of the business and of the owner? And really understanding kind of what is your 3 to 5 year goal. And an example, if an owner is sort of on the fence, I'm not sure what you mean by goals, I can't do that. It's something I've heard one of our owners, Adam, talk about is, okay, if I gave you $10 million as an owner, would you, okay, I am ready to retire and that puts me on the beach and you're thinking about selling, or with $10 million, I would invest significantly in expansion. I would buy another business. I would do something that could really prompt a conversation. So, okay, then our goal is you want significant growth and you want to do some acquisitions to get there. That very next step then is really understanding what drives the revenue of the business. You saw a couple of the non-financial metrics. Is it the hours and the average bill rate? Is it the number of trucks being repaired? What drives your revenue? What's your main cost driver? For many people, it's the cost of their people, but is there equipment and other things? And then what are these indirect costs of administration, sales, and marketing? But really understand those as much in the terms that the business owner speaks as it is the financial terms, because those are the terms I'll keep using. So someone that would come to me and say, well, I'm going to grow 20% a year for the next 6 years. Wonderful. You'll get to those revenue drivers and say, okay, that means you're going to be selling this many more of these units at this price. Can you do that? And that might have them say, no, I can't. So it's extra products, or I can sell it, but we can't make it. All these things that they understand in their terms, not the financial terms. So then a big part of my job is really I'm just looking at their financial statements and saying, okay, does that seem to align to what they've told me about the business drivers and the direct costs? To put those together, build the logic of a forecast that would say, okay, if you can tweak your revenue drivers this way, that drives your revenue. If you change these direct costs, like the number of people and salaries, that can drive those direct costs, and I can build in your indirect costs. To then come back with the owner and walk them through this forecast and say, here's what it looks like. Here's what you built into this. That understanding is really important, because the best forecast I have when the owner says, hey, I'm thinking about adding a salesperson. Great, let's pop open the forecast. What are they going to cost, and what would you expect from that salesperson? Oh, you're going to need to add some additional production people to get the work done. Let's get all that in. Before you spent $1 on adding that salesperson, you can say, okay, this is the outcome. And maybe it's a case where they say, I add a salesperson and it doesn't give them the result they want. They think they can add a little bit in revenue, but you're adding so much in cost, you're like, this doesn't make sense for you to do. Wouldn't you rather see that on paper where it's essentially free? It's just their time to do it before they've actually stepped forward, hired the person, and then get down 6 months down the road and realize the result that they've got.
And the cool part about that logic is that, that salesperson conversation is perfect, because what's usually attached to this is, how do I pay that person? Do I pay them a
Yep.
base pay and a commission, or how does all that work? Well, the cool thing about the modeling part of it is we can kind of build it out. Well, if you pay a base pay, here's what it's going to look like. Here's what hopefully your outcome is going to be. If it's more commission driven, well, we're going to build that into logic as well. So we can kind of see, hey, how does that play out on the end result? So we can kind of play all the different scenarios out, and really kind of see how that really does impact things. Because it's kind of funny when people come to us and say, I'm going to give everybody a 10% across the board raise, and
Sure.
and I've got all these great plans I'm going to do. I'm going to knock off and give them 2 weeks extra vacation and all this kind of stuff, and they never kind of sit back and think about, how does that going to impact everything? What do I have to do to offset it? Because it's not one of those things that you can just give, and you're going to have the same bottom line, right? That's not going to work. You got to have that give and take. If you're going to give, then you've got to take over here and kind of balance it back out. And that's a big thing that a lot of times we don't even think about, because a lot of the decisions that are made in businesses are emotionally driven. And what we try to do is we try to take those emotionally driven decisions kind of back into and say, okay, now based on that, here's what the outcome is going to be. Mr. Business Owner, are you okay with that? And if they say, no, not really, then it's like, well, let's tweak it until we are okay with it, right? Or let's go back to the drawing board. Or maybe they say, yeah, that's great. I'm used to having a 15-20% bottom line. I'm hitting my goals or whatever. And they say, yeah, I want to give 5% back to my team. Great. We have no problem with the decision-making process. It's just a matter of, hey, here's what the outcome is going to look like based on that decision.
Yeah. And that forecast scenario is in dollars, but it's also in those non-financial metrics. So Jody, as you talked about our own firm's growth, you've got the forecast that says it's this many dollars. It's also this many new clients, client starts, new employees. So you could be looking saying, oh, it's 15 more people to hire next year. That prompts a conversation. Am I good at that hiring process? And is that something I need to change or add a person to hire that many? And all the different pieces that go in there, onboarding that many new clients, is onboarding a good process? So it really has you look at all pieces of your business to say, can I support what that forecast tells me?
Mm-hmm.
So one financial measure that comes out of many is cash. And so this would be a nice outcome where this gold line is, well, this is your reserve goal. And given your forecast, look at all this cash going up for the client. And there's lots of different measures, but this could prompt a conversation of like, what are we going to do with that cash? I mean, is that money that the owner wants to take out of the business, and what happens if it doesn't? So you've got lots of measures, but this would be that forward looking piece that in the financial statement, you'd be measuring actual results against this. So I'll tell you a little bit about what we've talked about working with our clients. Here's a typical cadence if you're a CFO client, where we will tell you we'll meet 4 to 6 times a month. Many accountants will tell us, I meet with my client maybe twice a year. What could you possibly have to talk about with a client for once a week?
And we
So
know that because we teach a lot of CPA firms on how to provide
yes,
this type of service.
we
And
do.
so,
Yeah.
yeah,
Every week
very
I'm in
common.
conversations with those. Yeah.
Mhm.
So typical is the very beginning of the month. Week one, we are going through pipeline and we will pull measures out of their pipeline system. So like a HubSpot or Pipedrive, however it is they track their opportunities and also their committed work. And I have that conversation of, okay, how do the next several months look? How rich does your pipeline look? What is your close average? What things are going on? That's with the sales team where you can be saying, okay, you've got these 7 things you have to get done for what you're telling me you can get done. Are we getting these things closed? Is it really clear who's on point to do that? And if they see measures changing, like they're not closing at the rate they want to, how do we change that? For many of our clients, then we do revenue recognition. What jobs are ongoing and how does that relate to how they build those jobs? That's an accounting focus, but it's also a great look at their project. And then you can see the weekly short-term cash flow in there. And so that happens. Week 2, then you're really looking at the forecast. So once per month, we're looking at that forecast. Now, I've just done your sales update. So if it's a big change in sales, I can say, okay, when I reflect that into the forecast, here's how things look. Maybe they don't look so good. What decisions are going to make to make this look better? That's also a great chance for them to say, I've been thinking about adding some people, or we terminated someone, or we gave those 10% raises Jody talked about, something that you can reflect. Next week, then you can look at the financial statement. How did last month actually turn out compared to the forecast? How does the end of the year look with this most recent forecast just built in? And what actions do we need to take around that? And as we've talked before, a lot of the non-financial metric conversation, once we can look at that, how the month turn out. And then week 4 is usually reserved for just other things. Everyone has projects going on. And so how are we doing around those projects, or what things are important for them to talk about? Each quarter you have tax conversations and tax planning. So that might be the kind of topic that we would talk about in there.
Yeah, and I would say during our onboarding, which is again our first eight weeks with a client, typically it lasts between 4 to 12 weeks with a client. We actually set this cadence up, and so everything is set up in advance, and so the cadence is really dialed in. So if the client is looking at it and says, you know what, I really want my financials in week 2, I'm like, okay, great. And so then we put into place, okay, so now in order for us to do that, here's what you, Mr. Client, are going to have to do, or Mrs. Client's going to have to do in order to allow us to be able to close those books. You know, maybe your expense reports have to be dialed in, or your time entries if they're time shop, or if they're doing the bank reconciliations, not us, their bank reconciliations has, you know, whatever the situation is, we will outline it and make sure that everybody is on the same page. In order for us to be able to do this, here's what we have to have from you. And so that could be flip-flop. We might talk about the financial statement and the forecast during that same week. You know, that might just be one meeting there, and then the other 2 meetings are kind of ad hoc, like Tom was saying, where we're just sitting in the existing leadership meeting and listening in and providing a financial aspect to it. Because again, with the way that our system is set, you know, each one of these weeks, it's not the summit show. It's not we come in and we're talking the entire time. It's more so is we're sitting in on an existing meeting and listening to what they're saying, and then again adding the financial side to it. So it could be, you know, the first half of the week 1 meeting might be rev rec and short-term cash, and then the rest of it might be project management or whatever, you know, whatever the client's doing. So it could be it typically works if we're inside of an existing you know, relationship. We typically see that clients start forming those weekly client meeting, or not weekly client meetings, but weekly team meetings right around the $3 million mark. Typically, if they're below $1 million, they don't really have the infrastructure yet set to have those meetings. But once they start getting that 3 million, definitely by the $5 million mark, they're having these weekly meetings. At least the ones that are well run companies will have those weekly meetings, and we're again part of those. So we're not creating additional meetings for the client. We're just being part of their current management team meetings.
Yeah. So Krista, we've talked a lot about forecast, our tools, teams. We haven't talked very much about sort of the makeup of our clients.
Yeah. So as you can see on the screen, these are some of the clients that we actually work with. So from everything to creative agencies, law firms, and there are also like subcategories there too. You know, so if it's a construction company, maybe we work with HVAC companies. There's several different ones that we work with. They typically spend about $60,000 a year with us. And we typically lead with our tax services. However, we are focused on that profit-focused accounting that we discussed earlier, just to make more money for the client. Some of the other things that we do, if you think about the dynamic forecast that we mentioned earlier, within the restaurants, maybe, they add 5 more customers, or they're looking at adding an extra drink. So we kind of break down those KPIs, individual markers for the client.
Mhm.
So our next slide, what we see here is typically whenever you're talking about someone that's only making $100,000 in annual sales, they can pretty much do those things by themselves. Where we find our sweet spot is between that $1 million to $40 million in annual sales. And so you can either use a transactional person or a controller or a virtual CFO. And 80% of our business is in the VCFO services.
Yeah, and I would say, to add to that, Christy, when a client comes to us, typically when they're right at that $1 million mark, we are a pretty significant portion of their money, right? The cost for to bring on a CFO or controller, whether that would be an in-person person or a virtual person like we are. And so that's why we typically don't pick up engagements under the $1 million unless they're funded. If they're a funded engagement, high growth company, then we'll pick them up for sure. We actually have a person that specializes in high growth funded companies. But if they're not, if they're just simply bootstrapped like the majority of businesses out there, that transactional service, which is what I would say typically most firms provide, they just don't provide them at the level we provide it at, because we're actually meeting with the client, spending an hour a month going over, but that's all historical stuff in nature. Everything we talked about, future looking, that's that would not be included in the transactional side. So I'd say at that $1 million that Christy had mentioned, that's where we see them at the transactional, maybe the controller, type of service, but we don't have many clients on the team that actually, that are actually at that transactional level. The controller and the virtual CFO, like Christy had mentioned, are definitely our sweet spot. 80% of our clients are going to be in that bucket right there. And, that's going to be right at the $3 to $5 million mark. 5 million is our average client, and as Tom said, we've got a few clients that are over 40 million, but that's the exception. That's not the average. That's not our norm. One thing that we didn't mention is that, we are an evergreen service, and we do find that clients, as they get bigger, we just add more resources to it. So the engagement, the fees change, the pricing change, but we'll add more resources in the event that they go from a 20 million to a 30 million to a 40 million.
Mm-hmm.
And in some cases, the resource might be, hey, it's time to consider hiring somebody internally. You really need somebody internally. But they're hesitant because they've had us for 4 years. And, in those cases, we'll sit alongside a CFO and kind of fill the FP&A role, in which we're helping them, with the forecast, helping them with the outside information, gathering the information that the CFO would need, giving industry information that they may not have access to. We'll help them in that area there. So as they grow, a lot of times sometimes they grow and then they decide to go internally completely. Other times when they grow, they'll have us sit alongside. And I would say probably about a third of our clients will have us sit alongside, and then 2/3 we'll just simply help them, find that CFO to replace us.
Yeah. So, Christy, you mentioned the transactional other services. You want to tell a little bit more about?
Yeah, for sure. So with our services, you can pick and choose how you want to work with us. So as we mentioned earlier, the transactional service is more about the typical historical financial statements and things of that nature. We typically see ourselves in the controller and virtual CFO categories more often. And you can kind of think about these as gold, silver, bronze, or, any type of way that you want to look at it. But with the controller program that you can use with us as far as our services, that's kind of a lighter version of our virtual CFO role. And then the virtual CFO role is more of a partner, that we're chief architect, we're a coach, we work with you on a regular basis. And the big differentiator between the controller and the virtual CFO roles is that we meet with you once a week in our virtual CFO position, and then like every 2 weeks with the controller. And so I don't know if Jody, you want to expand on that a little bit?
Yeah, and I would say back in 2004, we implemented a subscription-based modeling structure, which was very unique to the accounting industry. And actually, we were the first to actually put it in place. And now you're seeing a lot of firms are rolling in the same thing. And so what that means is that, once we determine the level of service that the client picks, whether it's a virtual CFO, more in-depth strategy, really forward thinking, really kind of in the weeds. It's kind of an everything goes type of thing on the CFO side. We'll talk about that here in a second there. But with that, their fee is a weekly fee. We just simply take their annual fee, whether that's $70,000 or $80,000, divide that by 52, and that's their fee, which we automatically just zap their account every Monday. And so we don't send them an invoice, send them a statement because it's the exact same dollar amount. It's just simply an automatic, withdrawal, kind of like a Netflix type of a deal. And with a lot of with the controller, again, the same thing. Even though we're meeting with them only every other week, it's still just simply a weekly fee. We just zap their account, and clients love it. We've had no pushback since we've implemented it back in 07, I think, is when we started pushing it in, and the clients just love it because, again, it's not part of the conversation. When we're meeting with them, we're not talking about a bill. Our team loves it because, again, especially when cash flow is happening, that they don't have to worry about bringing that up every single time. Hey, our bill's here. I know you don't have any money, but our bill's here. That type of thing. That never happens because it's just an automatic zap out of the account. And so if you go to the next slide there.
Yeah, so this is, we talk about our transparency with clients. You can see exactly what you get, whether it's a transactional service controller or virtual CFO. And so on a weekly basis, we charge you, just like Jody mentioned, and it's $850 a week on transactional, $1,100 a week on our controller, and then $1,600 a week for our virtual CFO.
And again, those are averages. So it's going to be choose your own adventure. So when we go through, we price everything out. We find that the average CFO is about that 1,600. So let's say it is at 1,600. Well, does it change? It only changes when scope changes, right? And then at the end of the year, every year we look at that change, and just like everyone else should do in the world here, we look at it. We increase the fee by around 5% or so, based on what we're increasing our team's fees. That type, or giving raises to our team. And so it's kind of just again an ongoing thing. So it's looked at as scope changes, we change it, but as and all of the fee itself doesn't change unless there's high growth, and looked at on an annual basis.
Yeah, and that's part of the scope that we work through with you. Sometimes people want to add on services, and so that's when your price will change per week. So back into that virtual CFO role, you can see there we talk a lot about profit sharing plans and FP&A and mergers and acquisitions. We really set you on a roadmap of where you want to go in the future. So this is our service mix. As you can see, there's about 78% of what we do is in that controller VCFO services, and then a smaller amount in our transactional services.
Mm-hmm.
And so as far as from an accounting mix, as you can see, we typically lead with our tax services. And so that's most of what we have with our client, majority of what we do with our clients. But we also focus heavily on the cash flow that we mentioned earlier, as well as doing some account payables for clients as well.
And
as Christy had mentioned there with leading at the tax services, I would say about 80% of our clients, when we go through the mix, have us do their tax return. Not required by any means, and we play really well with others. But I would say during the engagement on the offset, it's about 50%. And usually, they're like, no, I've got this great accountant that we're doing the taxes for, and we're like, perfect, keep that accountant, not a problem. And then what we find out is that, after about 8 weeks working with us, like, hey, why don't you just go ahead and add that tax stuff to our stuff. And so It builds up to that. So, as we lead with our virtual CFO program, about 30% of our clients fall within here in some manner, where we're actually doing some back office type of accounting, whether it's the credit card expense tracking or accounts payable or spend management, or if we're doing like sales tax form or something like that. So we do perform the accounting function for about a third of our clients. But again, I would say that 99% of our clients come to us because of the CFO strategy part of the deal.
Yeah.
Is that what you're seeing, Tom? About the same thing?
Yes, exactly. And sometimes it changes over time, right? They've started and say, could you consider paying our bills, or could I add the cash flow to it? And that's part of just add-on services that we do for people.
Mm-hmm.
So how do you engage with us? Jody, they can reach out to you with an introductory email.
Yeah, I would say that what we found the most success here is that when you as a guide would reach out and just introduce us through an email. Hi, Mr. Mrs. Business owner, meet Jody Grundon, blah, blah, blah. You can put whatever you want there. But then what I'll do immediately after that is I'll send a follow-up email with a 1-hour consultation with it. So they'll get my calendar link. And so that we use Calendly for that. And so they get my calendar link and they can just really quick pop on that hour consultation. And during that consultation, we're actually going to go through scope and price. So we'll find out what their issues are, where they need, where they have improvements, what they're looking for, why they're reaching out to us, that sort of thing. And by the end of that, we'll actually go through and they'll have the price in hand. What we find that would be really important and highly success in engagement is that if the Pinnacle Guide attends these with us, it's not required by any means, but it's a really great 1-2 punch, because we can kind of go through there and we can get some insight from the guide on maybe some of the issues that the client's having. And they've already built that solid relationship with you, the guide. And so we don't want to at all step on that or impede that at all. And so with that, it's super important to have, I think, you in the meetings in this scope meeting here. And so once they've scheduled the meeting, we'll go ahead and notify you and then invite you to that meeting so that you can attend alongside the client. Again, not required, but highly recommended for you to be part of that. Because what we want to do, we want this to be a good 1-2 punch throughout this entire engagement. If you're meeting with the client on a quarterly basis, we want to make sure that we understand what you've told them, what your scope is, what your key metrics are that you're focusing on, so that we can then incorporate those key metrics into what we're currently doing and kind of continually updating that. And so when it comes to your meeting, everything is dialed in. And then the other nice thing about it is you're welcome to attend any one of our meetings with clients, which is kind of cool. So it's kind of an open door. Assuming the client would have no objection, which I can't imagine they would, we would have you attend any one of those meetings. So if you want to pop in on a forecasting meeting or a pipeline meeting, whatever that might be, definitely an open door there and very welcomed amongst that to kind of have more of a team approach to helping the client out. And so again, the introductory is really simple. Just drop a quick email. And typically to me, and then what I'll do is if my schedule is pretty booked, I'll include either Christy or Tom or Adam or somebody else on there so that there's an alternative schedule in the event that they can't find anything located on my calendar. Once they pop on, again, very simple. They use the link, they pop right on the calendar, and then that link is again an open link form. If they decide they have to reschedule whatever, they can reschedule within the Calendly app, and it's really super simple. And then, like I said, we'll go over price and scope during that meeting.
Jody, one of the things that I think is really cool that you do is you record those sessions as well, so that the client can, refer back to it. And then also, if it's a Pinnacle person, they can also, okay, this is what we discussed. This is a scope. And so I really appreciate when you do that.
Yeah, and the clients love that too, because what we'll do is on the follow-up email, we'll actually attach a link to the recording. And so the client can go back and reference it. Because, in some cases, they may have forgotten, or maybe they're looking at a few different opportunities and they want to kind of circle back, or maybe somebody couldn't make the discussion and it was kind of hard to explain it to them, where they can just simply pop in there and go through and listen to the recording. But the other nice feature about it is that assuming that the engagement does happen, because we close about 40% of our engagements, we pass this on to our onboarding team. So before the client ever meets our CFO has already listened to it, already knows all the pain points and issues that the client has, and it's kind of developing that formula in their head or on paper on how they're going to really kind of kick things off well. So the onboarding team, the CFO, are required to listen to the recording and kind of make their notes. And so again, the client doesn't have to repeat everything or rehash everything. Everything is already out there. So it's a great, it's great. It's a win-win overall. Client loves it. Our team loves it, and it really kind of helps engagement move along. Yeah, great point, Christy.
Yeah. So next chance for interaction, right?
Yeah.
Yeah. So again, we have tons of questions here, absolutely zero. But with that, if you have any questions, feel free to jot down there. Christy and I will be in Arizona next week with you all. So we'll be there. Tom's not going to be able to make this one, but you'll probably see Tom in some of the future events there. If you pass on to the next slide there, I handed out at the last meeting there a copy of Digital Dollars and Cents, and that's a guide that I put together. Oh heck, it's probably 3 or 4 years ago. I'm probably even off on that, but it's a book I wrote that kind of breaks down, everything that we do. We're very super transparent with everyone with it, and this is a book designed for service-based industries on how to be profitable, from metrics to look at, from cash and so forth. And it's a great book. The QRC code is down there. Feel free to use that, and you can and you'll have a digital copy of the book. You can get on Amazon if you want to buy it on Amazon too. And then Virtual CFO Guide. Yeah, Chris, you had it right there. Virtual CFO Guide, kind of giving you just a little breakdown on the different areas that we look at on the engagement. And again, it's a really nice little thing you can pass on to a client or prospect, whatever you might want to do there. Now, coming up during the next meeting here in Scottsdale there, we have provided a cash flow booklet that we put together. The team is actually wrapping that up as we speak. It's about a 50-page booklet talking about cash and forecasting, and really kind of digging into what we discussed a little bit today, but in more depth. And we're partnering up with Pinnacle there so that we can actually provide this guide to prospects, to clients, so where you can give this to a client, and and then it really kind of help speed the conversation along. And then in the event that they want to use us, it's kind of tied in there. But in the event they don't, they've got some information to use to kind of work on their own. So we'll be handing that QCR or QRC code, or whatever you call that thing. We'll hand that out on next week when we're in Arizona then.
Yep.
Okay. Sounds great. And you're right, Jody, we did not have questions from people that we need to answer.
So if any questions, pop them in real quick. Otherwise, appreciate you hanging on with us, and we'll make a copy of this recording. Will be put into in the library for future access.
Sounds great.
Thanks,
Okay.
everyone.
Thanks, everybody.